Volatility in the rand just compounding South Africa's economic woes this year. We may avoid a recession after better than expected growth in the second quarter, but the economy is still not expected to grow, basically, for the year. So how is this affecting the banks? Well, EY has recently released a report looking at that question. To discuss, we're joined by Andy Bates, Financial Services Africa leader. Thank you for joining us, Andy. So what's the overall picture? Like most companies, banks need the economy to grow. How have they been affected?
Well, we've run this study since about 2007, where we've looked at the half-year results of the major banks that are based in South Africa. And the trend that we've seen over that time shows that for every 1% increase in GDP, the banks will grow by approximately 4.7% in terms of their overall profitability. So as you say, it's a huge impact of the wider economy on the banks themselves. Obviously, what we've seen this year is a very low growth environment. The IMF are predicting 0.2% growth for South Africa in 2016. So we're starting to see the impact of that on the bank's profitability. And
what do they believe? That the worst could be over, or that it could go pear-shaped if we get downgraded at the end of the year?
Well, there's a lag factor with the bank's results. So one of the things we commented on 6 months ago when we looked at the year-end 2015 results for the calendar year ended 2015 was how resilient the banks had been. Because if you remember back to quarter 4 of 2015, there were some very difficult messages in the economy. Mining was struggling, agriculture was struggling under the drought. There was bad macroeconomic news towards Christmas. So we were amazed when we looked at the bank's results for last year. Returns on equity was still up at about 18 on average for the African banks, which was fantastic. So we expected there would be some sort of lag factor as the bad news in the broader economy flowed through into impairments in particular. And that's what we're seeing in the current period. So if you look at the first 6 months of 2016, you can start to see some of the bad news that there was in the economy towards the end of last year now turning up in the bank's results, particularly in the area of loan defaults, in the area of impairment. So I think as far as the bank's outlook is concerned, there is that lag factor. Many people are saying we have turned a corner. But your earlier item showed that volatility or rand weakness can often come back quite quickly. So I think it's probably too early to tell whether banks will be at the end of the year. But a sovereign downgrade obviously wouldn't help. And if there's more bad news in the broader economy.
A sovereign rating downgrade?
Well, at its core, it'll mean that it's harder to borrow. So what we see at the moment is banks have very healthy capital ratios. And if you look at the report that we released today, the range for the top 5 banks in South Africa is anywhere between sort of 10% and 14% tier 1, which is the best quality capital. So there's no concerns from a capital point of view. But what you'll probably see at the moment is that the banks are holding back a little bit pending what's going to happen at the end of the year, because it will be more difficult for them to raise funds if there is a sovereign downgrade, because it doesn't reflect on them per se, but obviously it does reflect on the strength of the South African economy as a whole, and therefore it would increase the rate at which they borrow, and then of course that has the knock-on impact of increasing the rate at which they would lend.
So overall, I'd love to look at the different banks, but first you say that the profits have gone from double digits basically to single digits. How significant is that for the banking sector? We know Barclays are looking at a sale, so that could be major. But could this affect jobs? Do you know what I mean? Could they ride the storm? What does it actually mean for the sector?
I think you have to make the distinction between the short-term headwinds and the longer term. So the particular survey that we've put out today shows that last year in the first half, bank profitability headline earnings were up by 17% on average, which is a great result. This year, that number's come down to 5%. If you get under the skin of that and look at the detail, the lending is still pretty good. Revenue is still pretty good. Expenses are under control, going up a little bit. But actually, the real area that's really been impacted is impairments, where there's been a big increase in impairments, loan impairments in the first 6 months. So that, as I say, is a function of the broader economic environment, particularly on the resale side and on the corporate side. And then if you look at the future, we think that the banking opportunities in South Africa, particularly for those banks which have some diversity outside of South Africa, so they're not dependent purely on the South African economy, we think the opportunities for banks to get back to the very high returns on equity are very, very good. So, you mentioned Barclays Barclays PLC have said that they will sell down their majority stake in ABSA. That is based on a particular set of circumstances which they face in terms of consolidating Barclays Africa into their group accounts. But we think if you look at it on a long-term basis, Africa is still a great opportunity for banking in the long term.
So is this the difference? Is it impairments and maybe activity in Africa? Because it looks to me like there's huge differences in the profits of the banks. Standard and Investec growing well above 10%, Nedbank by only 2%.
Yeah.
What's that difference?
It depends, I think, on the quality of the loan book, and also depends on the particular sectors that the banks are exposed to. So you're right, the average numbers that we've reported today, and I think it's 11% increase in impairments, but the spectrum or the difference between the highest and the lowest is about 38 down to -4. So some banks have seen a 38% uptick in impairments, some have seen a reduction. So it very much depends on the segments that the banks are exposed to. So if we look at the retail and corporate sectors, lending to the corporate sector has remained pretty high. Lending to the retail sector has definitely fallen off. So I think it depends on which strata of the segment you're exposed to, whether in the retail or whether in the corporate space. And I think what we're seeing probably in the retail space is the impact of high unemployment, impacting on people's ability to repay, and particularly in the unsecured lending space, which is where you would expect to see some of that noise or some of that pain first, because people are more likely to pay a mortgage if funds are tight than pay a credit card bill, let's say.
Impairments are a great gauge of how people are suffering, basically. Can you say from this data how many people in South Africa are not paying back their loans? Or are we talking about loans that aren't repaid over 3 months, basically?
Yeah, so the banks will have an impairment charge, which they will take, based typically on a 90-day failure to repay. So they will have slight distinctions in terms of what they regard as an impaired loan. But I think what you can see through that is definitely some distress coming through in retail. If you look across the board, actually, whether it's retail, whether it's corporate investment banking, vehicle asset financing, credit cards, mortgages, uptick in impairments in all of those areas. But as I say, if you look at the absolute numbers, most of the distress is probably in the credit card book. You'd expect that because it's an unsecured loan. But certainly a distinct uptick in the period on mortgage impairments, but also on corporates and other retail lending as well. So I think that can change quite quickly. So I think if we get back to decent growth in the economy, if we get back to less concern, if you like, about some of the other macroeconomic factors like raising interest rates, and then we talked about the sovereign downgrade, I think that could come back quite quickly. Because if you look at the long-term trend as far as impairments are concerned, very much on a downward trend since 2011. So for the last 5 years, we've seen a kind of slow decline in impairments. So we anticipated that this uptick would happen in this 6 months. We've seen that, but it doesn't mean that the banks can't get back to those lower rates again.
This whole relationship with interest rates interests me. So interest rates go up and the banks can actually benefit because they can charge those higher interest rates. But at some point it ticks over when everybody can't pay. Where are we basically now, in your opinion, on that seesaw?
So I think having seen the impairments go up in the first 6 months of the year, we're probably now in the environment where the banks are a little bit more cautious about how and where they're lending. Because you're right, they might yield on paper better profits, but that's no good if people aren't actually repaying. So what's interesting, I think, about the data that we've put out today is that corporate lending has held up pretty well. And interestingly, lending outside of South Africa into the rest of Africa has held up pretty well as well. So I think it depends on the segment that you're looking at. So I think where we are in that cycle is things look a little more constrained in South Africa than they did, because we are now in that more difficult cycle. But outside of Africa, outside of South Africa, where growth rates are a little bit higher, there's more lending going on.
Last question to you, and very quickly, please. The banking sector is well regulated, well respected. Recently, and I don't know if you can comment on the cabinet minister turning his lights on the banks, saying we need to investigate why the Gupta accounts were closed. Can something like that turn confidence around pretty quickly?
Well, the banks are well regulated, and certainly for the South African banks, it feels like a very mature market, both in terms of the customer base, but also in terms of the nature of the regulations. Whether you look at the prudential or the conduct agenda, we think that the banks are subject to a good amount of scrutiny, and we've seen fines in the recent past for breaches of things like the Financial Crime Act. So we feel that the banks are well regulated. I mean, as far as some of the other political noise, if you like, is concerned, I think that impacts on banks because it impacts on the whole of the economy, but it isn't necessarily something that the banks can control. So it's something that they will be concerned about, but it isn't necessarily something that they can do much about. So I think they will control what they can, which is respond to the SARB and the regulatory scrutiny that they're under, And then I think the main thing is really looking to government to create the right macroeconomic circumstances whereby the economy as a whole can grow. That keeps inflation low, it keeps unemployment low, it means more lending, it means more jobs, and then you get into that virtuous circle of growth. I think that's probably where the banks would like us to be.
All right, thank you so much for your analysis. That was EY's Andy Bates.